The 10-year Treasury yield topped 4% for the first time since November as investors remain concerned about the Fed's path ahead. Let's bring in Natixis portfolio strategist Garrett Melson here. Garrett, good to see you here with us this morning. First, just as we're trying to get and wrap our heads around all of these majors around 4% or at 4%, what does this signal for the Fed's policy pathway ahead and what the markets are already starting to price in?
Yeah, well, thanks for having me. It certainly has been a very interesting start to the year. You saw a very sharp repricing in the market to that soft landing scenario in January, and that's completely flipped into the no landing scenario that everybody's talking about now. And the basic premise is being that growth is starting to reaccelerate. You see a lot of signs in some of the economic data prints we've seen over the course of February. And the concern is obviously that that's going to lead to stickier inflation and potentially even a reacceleration. I think that's a little bit misguided because, there's a lot of noise in some of this January data prints, but nonetheless, the market narrative has really taken hold of that. And you've certainly seen a repricing of rate hike expectations. So it's not only just that final terminal rates moved higher, but you've seen some of those cuts that were priced in for this year and next, a lot of those getting pushed out or in some cases actually priced out. And so obviously you've seen a pretty sharp repricing on the front of that all the way out the curve as well.
And where do you think, say, the 10-year yield, Garrett, could top out? And then what would the implications then be across asset classes?
So, I think what's really notable about this move in yields is it's very different from what we saw last year. And I think there's a lot of indicators telling you that this is a different environment. What we've looked at is around 4, maybe an overshoot to 4.25 is, potentially in the cards here. So we're looking to add into duration at this point. And I think we're probably closer to the end of that move, especially when you put that together with some of the commentary we've received from Fed officials. But, I think you look at a lot of the performance in the marketplace here, rate volatility hasn't spiked nearly as high as it did with similar moves last year. You're seeing a lot of the defensive names in the markets and the equity market underperforming. You're actually seeing cyclicals outperform. So it's telling you a very different story than what we got used to last year. And I think that's one of the fact that you're seeing a lot of this driven by stronger growth and not necessarily slowing growth and higher inflation like what we saw last year.
Garrett, part of this story earlier this week, we saw Goldman Sachs doesn't think that PCE inflation will fall below 3% this year. Are you in that same camp?
We're a lot more optimistic on the inflation front. Now, that's not to say that we couldn't see it remain sticky around that 3% mark here. But I think when you look through some of the more recent data, there's still a lot of signs of some meaningful disinflation in the pipelines, right? We might not be getting help from the durable goods side of the equation much longer, as you've seen a lot of that inventory adjustment take place. But when you look at the biggest components in terms of that PCE basket, housing is still a very sizable component, not quite as large as it is in CPI. But we know that's going to be slowing down markedly over the course of this year. And I think a lot of the concerns really hinge on the fact that, tight labor markets are going to lead to consistent and persistent upside pressure on wages for a lot of these companies and therefore prices. And I think what you've actually seen is that, that jobs print from January may have been somewhat of an anomaly here. Not to say that it's a weak labor market, but you're seeing signs that, labor markets are normalizing. And so if we were to see that February print come in a little bit softer here, paired with, continued deceleration in wages, I think it's very reasonable to expect that you could continue to see some meaningful progress in disinflation as we move through the course of this year.
So what are the implications then? I mean, you talked about the cyclicals sort of surprisingly outperforming, right? Do you think that continues? Do you chase that kind of performance, or where do you go right now?
Yeah, so we're definitely leaning into that trade. I think the key is, one, you're seeing a reacceleration in growth, and that was very much underappreciated last year. We've been really zeroing in on that for a couple months now, and it's really starting to play out. Now, I think you do need to be careful in terms of what the duration of that reacceleration is and the magnitude of that. But in our view, it certainly is durable. You do have real incomes rising for consumers. You're seeing the labor markets remain strong. You're seeing some signs that a lot of these manufacturing companies are having to ramp back up production here to meet demand. So that's all helpful for the growth story. At the same time that a lot of the drags from last year are flipping to tailwinds, especially as you consider, housing becoming less of a drag, global growth starting to pick up here. So I think what you really do want to be leaning into is that cyclical trade again. And I think that's why you've seen it really really holding up here, even with this modest pullback from the early February highs. Now, I think the key, though, is that the risk that you're trying to hedge moving forward, it's not going to be the same hedges that work as last year. And I think that's why you're seeing the defensives underperform. It's not sticky or accelerating inflation with slowing growth. It's stronger growth driving that surge in yields and potentially leading to stickier inflation. And that's a very different backdrop. And I think that's even more evidence to lean into some of those cyclicals that might benefit as well from potentially stickier inflation.
So just quickly then, what should the hedges be now?
Yeah, so what we're leaning into right now is looking at opportunities to add into industrials, pockets of the materials complex. Think of materials and mining, some of the oil service names. I think those are areas where, yes, there's a little bit of a possibility of a consolidation here as they've had strong runs. But I think those are areas that are going to benefit from some of those persistent inflation fears. Think of it as kind of 2022 itis, that persistent fear of reacceleration back in the minds of a lot of investors. But at the same time, those are the same sectors that benefit from a reacceleration and growth. So I think that makes a whole lot more sense in this environment than those classic defensives that have really lagged the market over the course of the first couple months of this year.
All right, copy that. Garrett, thanks so much. Garrett Melson, Natixis portfolio strategist. Appreciate it.